Hello, hello. Welcome to CashFlow Hacks. I'm your host, Chris, and with me today is my co-host, Stephanie.
Hello, hello. I am so happy to be here with everyone else who's ready to make more, save more, and start living more now.
Well, who's not ready to start living more now, right? If that's you, you're in the right place. Every week, Stephanie and I are going to be sharing strategies that your financial advisor doesn't want you to know. And why is that? Because the less you know, the more they make. And we want to help you flip that script.
Absolutely right. So this week, we are going to continue talking about the 5 enemies of wealth. This is the 3rd episode in this series.
Well, as we talked about the last 2 weeks, we were talking about the 5 enemies of wealth, also called the 5 wealth destroyers. What are they again? Inflation, market fluctuation, devastation, litigation, and taxation. Today, we're going to be covering taxation. If you missed the others, well, all you got to do is listen to the last podcast.
Yes, and such valuable information was shared. So definitely go back and listen to the previous week's podcast. So today we're going to get started with taxation. They say that the biggest expense we have are our taxes. Chris, can you tell us more about that?
Well, what do you think? Taxes are definitely a wealth destroyer because our country is basically run off of debt. The only way that we're going to be able to cover that is through taxes, and we're not even touching the principal. We have interest-only loans. I'm saying our government has only interest-only loans, which means they're only paying the interest on these loans, which means the taxes are going to have to go up. How else will they pay for this? And besides that, you know what? There are so many different types of taxes that we pay. I'm going to just name a few of them. Well, as we talked about in the last 2 weeks, the 5 enemies of wealth, they are inflation, market fluctuation, devastation, litigation, and taxation. Today, we're going to cover taxation. And if you missed the last podcast, well, you're just going to have to go back and listen.
Right, because such valuable information was shared in our last podcast that you really want to go back and listen to those. Today, though, we're going to talk just about taxation. And they say that the biggest expense is our taxes. So, Chris, can you tell us a little bit more about that?
Sure. Well, let me just ask you this. Do you think taxes are going up or down?
Personally, I think they're going up.
Well, our country is run off of debt. And the only way that we're going to be able to cover any of that is through taxes. And we're not even touching the principal of these loans. The country has interest-only loans, which means they're only paying the interest, not any principal. So the only way to touch this is to raise taxes. And you know what? There are so many different ways that we pay taxes that many people don't even realize it. If we don't pay taxes, what are we told? We're going to go to jail, right? So let me just mention a few of them. There's income taxes, sales taxes, capital gains taxes, estate taxes, property taxes, just to name a few. And there's so many taxes that we pay. But really, the whole thing is just to let you know, just in case you didn't realize this, which I know everybody does.
Taxes, we all feel like we're paying taxes.
Right.
So you said something interesting, Chris. You had an expression. You said we're told to pay. What do you mean by that?
Well, I mean, we all have to pay taxes, right? That's just the reality, right?
Yeah.
But is it really? Before I answer that question, let me touch on a reason we're not taught about money or being an entrepreneur in school. That's because Uncle Sam needs more employees paying more taxes. So really, we go to school to become an employee. Sometimes a well-paid employee, but nevertheless not an entrepreneur. We're not taught to be entrepreneurs. And
right.
employees, why that's important is because employees pay more taxes than anybody else. Because entrepreneurs, business owners, they have options that employees don't. These options reduce their taxes, and the problem is that not everybody takes advantage of these because they've never heard of them. They don't know about them. And the real question is, we all have to pay taxes, but how much taxes do we have to pay? if we know how the IRS code works, which, I mean, that seems like pretty daunting task all by itself.
Right?
If we understand how the IRS code works, or we know somebody, a really good accountant, then they can help us reduce our tax liability.
Absolutely. That's so true. If somebody knows how it works, within it is written ways to reduce your tax liabilities. And that's kind of what we want to talk about in this episode. We want to share just 5 ways to potentially reduce your tax liability. And I just want to go ahead and say totally legal ways, right? In addition to taking standard deductions and other deductions, there are many things that you can do to lower the amount that you pay.
Right. So who doesn't like legal loopholes? I know I do. One way that I talk to people is, or I tell them about diversifying their streams of income. We don't want all of our income to be earned income. But when we're talking about tax code, we need to know what the difference is between them. But before we do that, let's talk a little bit about the tax code. I know you're always asking me,
who writes the tax code?
Yes, that's right. Who writes the tax code? So let me just say this. It's been said and often joked about that the tax code is over, and I keep saying, I got to learn how to stop saying it. The tax code has over 70,000 pages. Did you know that? And only about 30 pages are dedicated to actually paying taxes. The rest of those pages are all about how to avoid paying taxes. Obviously, it's written in jargon, okay? So nobody wants to read the tax code. I mean, do you know anybody that's ever picked up a tax code book and started reading it?
No one ever.
Only them people that are, well, you're kind of one of them numbers. You're a numbers person. You're a numbers person. I'm a dollars person. I can tell you all about money, but when it comes to reading the tax code, not interested, not even in the slightest. There is so much good stuff in there about how to avoid paying taxes. And I'm not saying we shouldn't pay any taxes, because, I mean, that's how we have our roads, that's how we have our schools. Taxes do pay for a lot of good things. However, it's been said, I don't know if you've ever heard, I think I've said it to you before, but the government spends money like a drug addict spends money. Like they spend money even when they don't have money.
I haven't heard that one, but that's funny.
Well, a lot of people are just handing over 30% of all their money to the government. Have you heard that?
Yeah. I can't tell you how many times I've had business owners say to me that they have like a bank account just designated for their taxes, which by itself is really good, right? You want to separate that out so that, you know, you're planning for paying your taxes. But they all tell me like that, I put 30% in there. I put 30% in there. And I always ask where they came up with that percentage. And they just say like, well, they heard it somewhere. They got cookie cutter advice. They just took it from somewhere. And that just brings to awareness that they have no tax strategy. All they have is some tax preparer that files their taxes for them.
Right. Well, I mean, it's not really their fault, because
no, not at all. Right.
Money really is a game. And there are rules to the game. Like I mentioned before, we aren't taught about these in school. Why are we not taught about them? Because if we know about them, they'll make less money. So the less we know, the more they make. And if we don't change that, it's like we're trying to reach a goal. And the goal is constantly the target. We have a target and we keep trying to hit it, and it keeps moving further and further away from us. Even though we're saving, we're doing all the things that we're told we're supposed to do, it seems like our target keeps moving further away. And another way of saying that is kind of like driving our car with one foot on the gas and one foot on the brake. So I would have to say that taxes are a very large expense, and probably our largest expense that we have. But I want us to share with our audience today some of our favorite loopholes, the ones that we use and the ones we share with our clients. Because I know that if they can take advantage of some of these, they can start protecting themselves from the taxation wealth destroyer. So let's go, Steph. What's the first one?
All right. So our First one is something people might have already heard, but that's converting your IRA, whether it's a traditional SEP or simple, into a Roth. So if you're over the age of 59 and a half and you meet the 5-year rule, the 5-year rule is that you have to have the money in there for at least 5 years in the Roth, I mean. If you have that, then distributions are tax-free. Everybody loves tax-free, right? Because at that point, they're not considered investment income. They're not going to increase your modified adjusted gross income. And so the calculation for your Medicare surtax, that 3.8%, that is not going to be applied. So it's awesome. So being able to convert that SEP, simple, or traditional IRA into a Roth IRA is a great strategy for reducing your taxes.
I love it because then all the growth from there on is not tax-free. The one thing you said, though, that I want to make sure everybody understands, you were saying if you are over the age of 59 and a half and you meet the 5-year rule, then it's just talking about the distributions there. You can actually do this when you're younger. You can convert when you are younger.
I wasn't talking about the converting of it if you're over 59 and a half. I'm talking about if you pull money out.
Exactly. I just wanted to make sure. I just wanted to make sure everybody understood that was just talking about the distribution, not. You don't have to wait till you're 59 and a half to do the converting. You can do that at any time.
Right. But if you try to distribute before 59 and a half, you will be hit with taxes and a penalty.
I know. That's the bad thing about any of the qualified plans is that you are in bed with the government. So what's the first one, Stephanie?
So the first one we're going to talk about is something that other people or some of our audience might have already heard before, and that is converting your IRA, whether it's a traditional SEP or simple, into a Roth IRA. So if you're over the age of 59 and a half and you meet that 5-year rule, which means that you've had your money in the Roth for at least 5 years, then the distributions are tax-free. Now, that's not to say that you have to wait till 59 and a half to convert. I'm just talking about the distributions being tax-free. So why does this happen? It's because the distributions aren't considered something called investment income, so they're not increasing your modified adjusted gross income. So you're not using this amount that you're pulling out in your calculation for that Medicare surtax, that 3.8%. So pretty much when you pull out your money from the Roth in your retirement, you're pulling it out tax-free.
So basically, Stephanie, what you're saying is you need to convert your traditional IRAs into Roth. I love that. I help a lot of my clients do this, and it's pretty exciting to see them be able to take their money out tax-free once it's been in there for the 5 years. The growth is phenomenal, and it's really nice for them when they get to pull it out without having to worry about paying any taxes on it.
Right, because having $100,000 tax-free to spend is different than pulling out $100,000 and having to pay taxes on it, right?
Exactly.
You can do a lot more with it.
So, what's the next? I know we were talking about for business owners, we have some strategies for business owners. Can you share those?
Yeah, well, so a strategy for business owners is considering restructuring their business entity. So I know that there are a lot of different business entities out there, and people are operating as a sole proprietor or an LLC or an S Corp or a C Corp or an LLC filing as an S Corp. There are many different ways out there. But really, speaking with an accountant, you can find out which business entity is best for you and possibly restructure. So, for example, S Corp can save the owner money because they're able to pay themselves a salary, something quote unquote a reasonable salary. And that's subject to that self-employment tax. And for those of you who don't know, the self-employment tax is about 15.3%. 12.4 for Social Security and 2.9 for Medicare. So what happens is that the salary gets hit with that 15.3%, but the rest, the distributions, come through on their regular income tax rate. So it's a savings for them not to have to pay it on the total, which would happen in an LLC. Actually, there's this new 20% deduction of business income for pass-through entities like LLCs, right? And then we have some really cool strategies that we talk to business owners about like hiring their children, and they can pay them. It's a little over $12,000 without, having to match payroll taxes and things like that if they're a sole proprietor. And just like, so there's different tax benefits for each entity type. Like for C Corp, they're lower at the top than for the other business structures. So don't just do a business entity because you think that's the right one. Like somebody, me, learned the hard way, like that I wanted to say that my business had Stephanie G Inc. until I got incorporated just so I could say that. Kind of silly, right? But you want to work with an accountant that will tell you, okay, based on where you are in your business, how much money you're making in your business, and whether you have children, that you can utilize some of these strategies like paying your kids or different deductions like home offices, like whatever it is, work with an accountant so that they can tell you what structure or business entity is the best for you, because it can be totally different one from the other. And there's no best one. I think this is something you and I talk about, Chris. There's no best one. It's just what's best for you as, where you are in your business, right?
Exactly. When I learned about this, I was pretty stoked. I realized you didn't even have to be registered as an S Corp. You can be an LLC and file as an S Corp, which saved me a lot of taxes in the beginning. And so one thing you said that I was going to tease you about being a C Corp, being incorporated. Why do you think that wasn't the best choice for you just because you wanted the Inc? What did it do to your taxes?
I get double taxation. But so I was silly because when you get your website, when you start your business, you get a website, right? And so I wanted it to be stephanieg.com, and somebody else had stephanieg.com, and I didn't like the sound of stephaniegllc.com. So I was like, okay, stephaniegink.com. That is the silliest reason in the world.
Well, and I love our
decision. That was like so silly.
But it's good that you told people that. I mean, it's like they need to know that when we're making decisions, it's very important that we have the right entity in place, or it could cost us money.
Yes, very true. So learn from me, everybody that's listening. Speak with a CPA. Call us. We can share more. Chris can share more. One of the things that we always talk about is how we educate on the things that we learn about. So if we made a mistake, we learned from it, and then we're able to help prevent others.
Well, mistakes are our biggest learning
opportunity for learning.
Opportunity. Yeah. All right, give us another tax strategy.
Okay. The next one is investing in tax-exempt bonds. So this is a really cool strategy that I always talk about with clients, because any interest that you earn is not subject to federal income tax and Medicare for tax calculations. So what do I mean by tax-exempt bonds? A great example is municipal bonds. So what a municipal bond is, a bond is nothing more than a loan. And what you're doing is you're loaning the municipality money. So it could be you're loaning them money to pave a new toll road, or maybe fix the water main. And the really cool thing about that is, generally speaking, if you get the right kind of muni bonds, like it's an income or revenue generating bond. So like you're going to get your money back because, hey, people are going to pay tolls on that toll road. So there's income coming in. And no matter what's happening in our economy, people are still going to flush their toilet. But like, so we know that that water main is going to still have income coming in. So you'll get the money back. But the municipality, for raising its own funds, was given a tax kickback by the federal government. They're like, hey, you went and did it by yourself. You're not asking us for money. We're going to give you this tax benefit, for the lack of a better word, so they don't get taxed on it. So that trickles down to you, and you don't get taxed on it. And the cool thing is that if you are in the state that bond is from, the state also gives you that tax-free status in some states. But there are some states that you don't pay any state taxes on these types of bonds. In Florida, I used to live in Florida, and I didn't have to pay any on muni bonds, and it was really nice.
I like that. I like it a lot. That's just another reason I want to move to Florida. Besides no state income tax, I don't have to pay taxes on the muni bond. That's great. Let's see. Though I know that there's some other states that don't have income tax and don't charge for the muni bonds. And I was looking this up at one time and I wrote them down. And let me tell you, if you live in these states, take advantage of this, guys. It's Alaska, Nevada, New Hampshire, South Dakota, Tennessee, Texas, Washington, and Wyoming. If you live in those states, take advantage of this. This is a nice way to grow some of your portfolio without having to pay taxes on it.
Right, and a tax-free strategy.
Yep, that's why I'm moving to Florida. Not just for this. So what about the HSA? I know that this is something that I have recently been taken advantage of, and I would love it if you could tell our audience about the HSA.
Yes, of course. I really love HSAs. I call them the triple tax savings account. And what I mean by this is that if you qualify, 1, your contributions are tax-free. 2, your earnings grow tax-free. And 3, your distributions are tax-free if used to pay for qualified medical expenses. So I find it so awesome. I mean, you have the option of investing these funds if you don't need to spend them on medical expenses, which is a really cool ability with an HSA. So you can use the money for medical and dental expenses and related costs like that, over-the-counter medications, first aid supplies, and everything's tax-free. If you do need the money and you pull it out for non-qualified expenses, then you will pay taxes on your withdrawals, but it can really help you with healthcare needs. And it can help you save for retirement at the same time because it's providing you the tax benefit that makes it a worthwhile investment, right? So we can put this money in for the HSA. If we need it for the medicals, we can use it, and everything that we don't use, we can have it grow for the future. And so one thing that's like really important about it to know is that it's your money forever. So unlike if you wanted to contribute to a flexible spending account, an FSA, it stays yours. So the FSA, you have to spend it during that tax year or you lose it. But with the HSA, it's always yours. So that's why you might want to consider an HSA over an FSA. But you might need to weigh the risks of having a higher deductible against your potential savings, right? You got to think about that too. But I like HSAs.
Well, I like HSAs. The only bad thing about them is that they only allow you $3,800, something like that. It's not very much. And I mean, I know everything adds up. So the tax savings would add up on this. My issue is like I have a $9,000 deductible for my health insurance. So I spend this $3,800 in the first month. So, but it's nice I didn't have to pay the taxes on that. But there's a lot of people out there that don't have medical bills like that this could actually add up, and they could end up having quite a bit of it later on, especially if they don't have a lot of help.
Right.
There is one more thing I want to talk about, though, that I found to be really cool. It'll be the last thing we talk about, but I want to. It's about inherited real estate. How many of you have inherited real estate? How many people have their parents pass away or a grandparent pass away and they were left a home? And the deal is that let me give you an example. If say your parents bought a house and it cost you in California, okay, well, they bought a house for $50,000 on the beach, like 50 years ago, and they still have the house in the family. And now that house is worth millions, over $1 million. Well, guess what? They're going to have to be paying the taxes. Or if they would have sold it before they passed away, they would have been paying taxes on the difference between the $50,000 and the $1 million. And the same goes for you. If you move in the house and if you hold on to it, you're going to have the same kind of situation. You're going to be required to pay the property taxes on that amount. If you keep it and the value continues to go up. But if you get rid of it, like immediately, you put it for sale, you get it and it's worth $900,000 and you turn around and sell it for $900,000, according to the government. you haven't made any money. Even though you really did make money, you don't have to pay the taxes on that. The other thing that you can do is, if you don't want to just keep that $1 million or whatever it is, you can put it in a 1031 exchange. And basically that means that you sell it and you roll it into another piece of property, and you don't have to pay any taxes, no capital gains tax on that. I don't know. I found that exciting, and you probably could have explained it a little bit better. You could have explained it a little bit better, but when I learned about this, I said,
wonderfully.
Wow.
Yeah.
I said, wow, this would be a great thing. But
I think we should actually talk about that a little bit more in depth in another podcast, because I think that there's a lot of different ways that people don't even consider when it comes to investing in real estate, and, you know, how to do 1031 exchanges. And I think that would be a great topic for a future podcast. So we should put that in the roster. Actually, you know what? I'm going to put that in the roster. So, yeah, but no, I think that you explained that very well. And thank you so much for sharing that. I learned a lot, as I always do. You answer my questions. But I'm curious, did we answer all the questions from the listeners? We, like always, want to hear from you. What do you wish you knew more about? Did anything that we started to discuss pique your interest and you want to know more about? Leave us a 5-star review on Apple Podcasts and ask in the review, and we will answer it on our next podcast. We do it every week on Wednesdays. And you can also share or send us a message on our Facebook page. Any way that you get a message out to us, we will answer your questions.
Well, that wraps us up for this week. Thanks for tuning in. Join our Facebook group, CashFlow Hacks, and follow our Facebook page, CQ Consulting Services, our Instagram and Twitter. Thank you for listening. We'll be back next week with the topic of more tax saving strategies. Peace out.